Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 6th edition of Market Outlook. Lots of interesting market action. Let's get right into it. Um, First of all, on the daily charts, we can see that we've got a really nice downwardly sloping channel. We're basically about mid-range, certainly the upper end of the channel here, where it runs into major resistance is around the 208 to 210 levels. So that would be a pretty high-end estimate of where we could get to before we run into pretty major resistance. Now, we're not overbought, but getting closer to it on a short-term daily basis. Volume is definitely favoring the upside. We've had a number of what I would call weak accumulation days. And a weak accumulation days is when you have up volume exceeding down volume, and you have the market closing to the upside. But it hasn't really surpassed the total volume for the day has not surpassed the 50-day average. So what I would call a somewhat positive accumulation day, but not overwhelmingly so. So you do have some resistance at the declining 200-day moving average, as well as that 50. The 50 is is also flattening out, but still overall really in a decline. So what you have here is a decent recovery phase where it's going to be attacking this 200-day moving average. So potential reversal pattern to be looking out for over here. Now, one thing I do want to go back to is the monthly chart on the S&P. So again, we're defining here long-term support comes in around 162. And in the event that we break down beneath the 180 level, which is the bottom of the channel, which I showed you on the daily chart, it's also long-term monthly intra-month support. If we break down through there, it's pretty significant. Another thing to note, at the end of this month, March, if we close under the 190 level, it'll be the lowest close that we've had in about a year and a half to 2 years. That will be significant. And as you can see, on a intra-month basis, we got down to the 181 level several times, but rejected it and closed above it. So your key point that's not quite obvious is really a monthly close beneath 190. But also note, when I talk about this is a dead cat bounce, the longer term monthly momentum here has definitely rolled over. This is a moving average of it, and it works really pretty well. And you can see ever since 2009, 2000, the late part of 2009 and to 2010, this monthly moving average, right, has steadily moved up and only recently is starting to move and roll over. That's what happened exactly before the crash in 2008. So we definitely have some resistance coming in. Again, right around that 200 level. Definitely there's that resistance at that 200-day moving average, just a little bit above here. And again, long-term resistance, lots of overhead around that 210 level as well. So again, with the momentum rolling over, it's not unusual to see this type of rally. Now, one thing I want to show here is a historical view of momentum going back to 2009. And let's take a look here. So one thing to note is that the monthly momentum chart here rolled over in 2015, just a couple of weeks really before the actual sell-off. Now, it did something quite similar back in 2008 and 2009, where it broke down right here as an early warning well before. This is a chart of the pure momentum of the S&P. It broke down early, tested the actual moving average of the line, and had a meek rally above it before it ultimately failed. And this is sort of the pattern that's playing out here as well. We got the break, sort of a test of that 200, or it's a, this one in particular is a 36-month moving average. We basically tested that just recently, have a slight rally off of that level, sort of similar pattern to what's happening here back in 2008. All right, let's take a look at a couple of other things. On a shorter term basis, looking at junk debt versus TLTs, which is really a fear gauge. You've got a situation clearly on a short term basis where the fear has moved out of the market because junk debt has definitely improved relative to TLTs. So on a shorter term basis, definitely an improvement, even potentially tracing out a head and shoulders type bottom formation if we can get above the recent highs in the junk debt here as well. So that's something to keep an eye on and confirming indicator. Sometimes they go opposite directions in terms of the market, but clearly with the market trading up on Friday, junk debt did, but did not take out its highs. So interesting. Let's take, you can always take a look at if we exceed the highs of last week in junk debt, that would give you another clue that rally mode is still on. Let's take a look at some of the market internals. This here, market internals, this cyan line is showing the number of stocks above the 10-day moving average. We got a bit overbought, and sometimes when you get very overbought, it tells you that there's room for a very short-term correction, but actually overall some more power to the upside might be left. And according to this, we definitely had that little bit of a correction and move back up. So this is telling me there's potential very short-term correction over the next couple of days, plus a resume rally that would actually end up at those upper regions in the mid 200s in the S&P, and then a potential rollover, or maybe even a little bit sooner. But we still might have a bit more to the upside. So pattern is short-term correction because we're pretty overbought. Another test that ultimately fails. Exactly where that's going to end up failing from remains to be seen. Okay, let's take a look at some market sentiment. The VIX, VXX, as you can see, sitting right on the 200-day moving average. That should be some level of support. In addition, we're at the bottom end of the Bollinger Band. So if we drop through it and come back, that would sort of be in line with the overall picture. Again, you can really use this lower end Bollinger Band, close under it as a penetration. That sentiment has really gotten extremely frothy to the upside. Not quite there at on that end, but certainly possible that we take out the 200 and the Bollinger and then move back in, and that would tell you that the rally is over. Okay, let's take a look at gold. Interesting, as you can see, gold definitely in play here. We broke out of a pennant formation. We did have a potential exhaustion type situation, although we didn't have massive volume, so it's probably more suspect as a blow off here. I would discount that. Really would look for a huge amount of volume to the upside, and then a lower candle close in the bottom 25%, to see a blow-off rally. Doesn't look that way. Now, what is interesting is that commodities are definitely in play. And, the Fed has been trying to spur, and central banks spur some inflation because there has been deflation. And guess what? Commodities and commodity-related plays like silver, steel, all this have had a great move. So let's take a look. This is DBC, which is a commodity index, and it's a lot of metals are in it, and you can see that has really moved out for the first time above its convincingly above its 200-day moving average last week. That's the first time since November. So real play in commodities. It's affected Brazil and a lot of commodity-related countries such as Russia. Take a look at Russia, right? Nice move up in oil as well. And you can see Russia's moved from 12 all the way up to almost 16 on Friday, and also with good volume. So is inflation coming back? Certainly there's some indication here that the downtrend in commodities might have been reached at the bottom of it, and now we're certainly on a nice rally here. Let's take a look at some of the agriculturals, which is DBA. And you can see DBA not quite as convincing as the metals and oil-based ETF, but still a really nice move on Friday, broke out of this base. So definitely inflation and certainly the commodity-related plays are showing some very interesting strength, and these are early breakouts. I mean, look, the DBA commodities, over the last year and a half have dropped quite a bit, and to a point. Let's take a look at the weekly charts just to get a perspective on commodity prices, and you can see, right, back in 2008 we were trading in the mid 40s. We're down over 50%, of course, while the U.S. stock market has done extremely well. And that is really the headwind that the central banks are trying to fight. So again, commodities look like they're in play. If this is a turn, they've got a lot more to move. The Fed may have gotten what it wished for, which is a turn in some of the deflationary pressures on metals, oil, and raw commodities. And that is your core theme. All right, that's it for now. Hope this helps, and see you next week.